Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler talking money and investing right here. PaulWinkler.com is the website. Of course, we got the tax workshop that we're going to be doing. Evan and I are going to be doing this Thursday. You can sign up there for that somewhere on the website. You guys are smart. We'll figure it out. I haven't looked at it. I'm sure that it's on my website someplace. I'll have to go check it out later. I've been so involved in just research, looking at the new things coming about. And I've talked about this a couple times this week, and I thought I'd just dig in just a little bit more regarding some investments coming to your 401k pretty doggone soon here. And that's private equity. It's just all the talk. People are talking about this pretty significantly. There are a lot of conversation about, what's going to happen with private equity? How is it going to affect investment markets? How is it going to affect 401ks? Letting people actually invest in these things. Now, I'm just going to give you the audio segment first, and then I'm going to go through a lot of written material and just what the research is, because this is what you're hearing. If you watch anything on TV, you hear financial people talking about this. This is what you're hearing.
In the defined benefits world, it's about a third allocated to private assets. And it's allocated that way because the performance...
Defined benefits, what he's talking about there is pension plans, by the way. Defined benefit, that's a fancy term for pensions.
Performance has been so strong over time.
It's been so strong in pensions is what he's telling you. So you're thinking, well, the pensions are doing this, you ought to be doing, right? That's kind of the idea right here.
Pension funds more allocated to privates have done meaningfully better. There's also big diversification.
Has there seemed to be any question in this guy's mind that this is a better way of investing? It sounds pretty good.
Benefits, exposure to real estate and infrastructure, to a bunch of private companies that are not in the public world today. And the S&P 500, 40% of its value almost is in just 10 companies.
And that's true. That has been something I've talked an awful lot about. And that's why you don't put all your money in just that one area of the market. Or, it's like target date funds that tend to be so focused on that area. That's the problem. Well, you have so much concentration in a couple areas, but you don't just have to do that. There are a lot of other things that you can get access to that you can invest in your 401k typically. Now, some 401ks are terrible and they don't have a lot of that diversification. But, the reality of it is that most of them do have some semblance of the ability to diversify across other asset categories. So he's saying because of this concentration, you need to do this private equity thing.
So there are a lot of benefits. And then we have this sort of, I'll call it a have-nots world in defined contributions where there's no exposure to privates.
So, have-nots, in other words, the general public doesn't get to quote unquote benefit from this is kind of the idea right there. They're the have-nots. It's, FOMO at its best, right? Fear of missing out. Oh my goodness, you guys are missing out on something really big and you need this. And he's talking about defined contribution plans right there. That is a fancy term for 401ks, 403bs, and where you're contributing money to the plan.
And so the question, and this is a good question from you, is can we do that responsibly in defined contributions? And I would say the answer to that is yes. And the reason is there's a ton of guardrails around ERISA and retirement. There are companies that are sponsors like us or other firms who have employees.
Now, of course, you see that he has a conflict in there because he's sponsoring this stuff. He really wants that, because if he can get access to your money in his 401k, that helps him. But just recognize he's saying now we're going to have all kinds of guardrails. Well, what is the whole thing about private equity? There aren't guardrails, as I'll talk about in a second. You have a lot of freedom when you're private equity to do a lot of things without anybody watching over your shoulder. And that's one of the big problems. And he's going to say all of a sudden now they're going to have that? Well, if they introduce all kinds of guardrails, the cost of capital or the expected returns tend to go down when you actually put all those guardrails in place. Not that the rates of return are great, as I'll talk about in just a second, but you have even something else that is stymieing the rates of return in the future for these things if you put those guardrails in place, because that's the whole thing about private equity. It's private. You don't have to give away information on your company.
They hire consultants to advise them on their 401ks. Then they hire investment managers. The biggest in the space is Vanguard. And then there'll be a minority of assets that'll get allocated to privates. And so there's all sorts of controls here. Individuals will still have the same underlying liquidity. I think this is the right thing to do. It lines up duration of assets.
So we're going to put so little money in this thing that, it's going to benefit greatly. You're going to much higher rates of return, allegedly. But we're not going to hardly put any money there, is basically what he said. And you're like, which one is it? Who's going to benefit more from this? But
that's higher returns with long-term retirement.
You like that higher returns. So he's basically saying it's going to be higher returns, higher returns, higher returns. You got to do this. We really need to do this. Well, there was an article in investors.com. It says, should you add private market investments to your 401k? And it says, proponents of adding private investments to workplace retirement plans say it's the next step in the democratization of investing. Privately held companies outnumber public companies 25-1. And it is. You do have. That's why you want another reason you want to diversify internationally, because the number of companies in the U.S. peaked at about 7,300 in 1996. Now it's down to about 4,300. But you have companies, tens of thousands of companies all around the world. You don't just have to be in one country. But anyway, that's one of the reasons they're saying you got to be able to do this. We got to have more companies that we can invest in. Private investment vehicles would only be available via so-called managed accounts such as target date funds. So basically what they're going to do is they're going to say you can't have this, but it'll be inside of a target date fund. So they're really limiting your ability to get at this stuff. And, target date funds, retiring in 2040, retiring in 2050, you just buy that one fund. But it's going to be inside of it. I thought that's interesting that it's going to be limited to just those funds. Critics say that only pension funds, endowments, and ultra-rich investors should own private investments. Only people that can afford to lose money should be actually in these things. That's basically what they're saying right there. They say that such investments are not suitable for mom and pop investors. The reason? They say that these so-called alternative investments lack transparency of publicly traded investments. That has been my argument. You don't know what the heck you're buying. You don't know what the earnings of these companies are. You don't know what their cash flows are. You don't really know what you're owning. How do you know what to pay for something if you don't have information on this stuff? And that's part of the benefit of being private is you don't have to give away this information. But here's the thing. I'm going to continue the sentence. They say these so-called alternative investments lack the transparency of publicly traded investments, and they charge higher fees. That's a big reason they like this stuff. Literally, the management fees on these things can be 5 times the level of other investments. 5 times the level. Difficult to sell in a heartbeat like a share of Apple. So they're not liquid. I can't get my money out. I can't move out of that. Now, it says not everyone agrees that these things are going to be great. And again, there's another dissenting view. Now, pardon the politics, but, a lot of times, there were people I disagree with, but there was a ranking member of the Senate Banking, Housing, and Urban Affairs Committee that basically blasted the proposal to include private market investments. And this person made a really good point. In a recent letter to Empower's CEO, Empower does a lot of 401k plans, as it wrote, studies suggest that private market investments have consistently underperformed. Now, that doesn't sound anything like that previous guy, does it? Consistently underperformed as compared to publicly traded indices. Despite these underwhelming results, private funds often charge, this person said 20 times as much in fees as mutual funds. That may be a little bit over-exaggerated, but I saw there was about 5 times. At the same time, private funds have weak transparency, illiquidity, compliance requirements, and lack investor protections. If there's a silver lining, it's that the 401k sponsors are aware of the risks. This line I thought was funny. Just check out this line is a hoot. If there's a silver lining to the criticism. It's that the 401k plan sponsors and asset managers are aware of the risks. And as a result, these key players are sure to take necessary steps to avoid mistakes. Wait a minute. They're not even denying that this stuff is happening, which I think is really funny. Another drawback, is said, is that many retirement plan participants might not have full understanding of how private investments work. I mean, you're going to be investing in this thing in your 401k. I have no clue how this stuff works, but they told me it was a good thing. It was going to get higher returns, right? So you just go stick your money in a lot of your life savings in this thing. And it says, when we're advising clients on private investments, we go through a rigorous suitability and appropriateness determination to see if the investment might be right for them. And, okay, what is that process? How do you know it's going to be appropriate? You don't have any transparency on this stuff. But this is another line that I just cracked up at. Check this out. To solve for this issue, to solve for all these problems, Empower requires that plan participants can only access private market investments through them if their employers offer them. Now, the reason that's so funny to me is because I have been in this industry well over 30 years. Used to do 401ks, did a lot of them, set up a lot of them, still have a lot that I work with. And I'm telling you, the employers don't know this stuff. They're relying on whoever's selling the 401k to make sure that what they're doing is okay. And if the employer's offering something that doesn't necessarily, because case in point, look at these target date funds. Look at these asset allocation funds that overly concentrate in big U.S. companies. That's case in point that a lot of times the employers just don't know this stuff. When we talk about how these investments are chosen, I'm telling you, a lot of times it is chosen based on past performance. Something's done well in the past and they add it to the 401k. Well, what goes up comes down. It says American workers appear to be adding private investments to they're open to adding this stuff. Why? Because they're hearing garbage like this, that it has great returns. And they're hearing this data, which I'm going to talk about more in just a second. Hang tight. 8 out of 10 respondents think that retail investors should have access to the same investment products as institutional investors. Well, if you open up institutional investments to the general public, then you take away some of the trading advantages that institutional investors have. Institutional investors, what is that? That's where you have to have a large sum of money to invest in this fund, a huge sum of money. When you have to have a huge sum of money, it tends to be bigger investors that tend to be a little bit more stable. And that allows the institutional investor to enact trading strategies that can keep costs down. But if you're opening it up to the rank and file investor, that trading strategy advantage tends to go away. So we're saying we ought to just give them access to all this stuff. It says 3/4 believe that and a lot of people have access to this stuff in their 401ks anyway, institutional. 3/4 believe that having professionally managed private investments in retirement plans helps level the playing field for everyday investors. And 72% said that diversifying their 401ks with some private market exposure could improve long-term investment outcomes. So, that's what they're hearing. They're drinking the Kool-Aid. They think that's going to be in there. That's going to be beneficial to them. The savvy of the money management team is key. Says McCarran. A good manager can identify fast-growing, successful company before it becomes public. Okay, so check this out. The savvy of the money management team is key. How sharp are these? How savvy are these people? How do I determine how savvy they are? Who's savvy and who's not? Well, you might say, well, Paul, you look at their past performance. If they have good past performance, that means that they're savvy, right? Well, what do we know about past performance? It's in your prospectus. Past performance is no indication of future performance. In fact, it's almost a negatively correlated thing. In other words, what we have found historically is fund managers that tend to outperform in one period tend to underperform in the next period. which tells you what? It was luck. It wasn't skill. So if we're looking at this saying, well, these people were savvy, let's let them choose these private placements. And then all of a sudden they lose their gift. You got a problem because you're the one that ends up losing the money. And there was a thing that was out there. There was something. Boston College had an article about this thing. Boston, there have. Let me see if I can find this. Boston College, Boston University had something about this. Let me see if I can find that. But anyway, so yeah, there was something about returns. There it is. There it is. I found it. Okay, got it. How do public pension plan returns compare to simple index investing? This was a hoot. Public pension plans have been shifting more toward complex investments the past 2 decades, moving a sizable share of assets out of traditional equities, bonds, and cash into alternative assets, and expanding their reliance on external managers. Some recent studies argue that pension plans could have done better solely in just investing in index funds. And, if you hear me talk about index funds work really well with large U.S. stocks. Indexing works well with the S&P 500. It works well with the Europe, Australia, Far East, big international stocks. It doesn't work that well with small companies and value companies. But yet, even still, the public pensions would have done better just using that. And it says critics counter that this assertion depends heavily on the time period analyzed. And that's true. And so studies, for example, studies that focus on the past decade with strong and consistent stock market growth, what grew well in the past decade? The S&P 500. That's what grew well in the past decade. Now it says when strong and consistent market growth favored index funds over active management, it didn't favor all indexes. It only favored the S&P 500. Again, that's the myopic view that, typically critics, they focus on one area of the market. It may overstate the advantages of passive investing. Now, here's the deal. They're saying that critics counter the assertion depends on the time period. I am going to strongly disagree with that. There was a Nobel Prize awarded more than a decade ago. About 12 years ago, in fact. And it basically was awarded for data going back to 1965. This isn't new. This is not new. This isn't something that, all of a sudden, just in the past decade, this has been better. This has been around a long time. Very, very misleading. But pension funds also regularly adjust their targets based on evolving beliefs in capital markets and diversification, which reflects a more active investing style. A style that we know through research just doesn't work all that well. Active management. Now, they continue to go on. It says, importantly, these results likely overstate the performance of pension funds due to the costs associated with complex active investment approaches, because they're trying to prove that these active approaches actually increase returns. They're trying to show that they increase returns over markets, and they're ignoring a lot of the expenses and unreported fees. Overall shift toward more complex active management strategies raise concerns over pension fund investment practices, they said in the article. While recent studies have argued that plans could have done better by relying only on simple index funds, the studies have been critiqued as being too dependent on the time period and using lagged reporting returns. Now, there's truth to that, since the talk of indexing typically only involves U.S. large stocks. And what they're doing is but the reality is that big U.S. stocks they tend to index are way better than the small in value. If small in value don't index very well. But since that market has done better recently, they have a point. But I think it would be a bad point because they aren't comparable, because private equity would be smaller companies. You can't compare it to that. You can't compare it to large companies. So it's a bad comparison. But if you were to compare private equity and you're looking at it versus the appropriate asset category, I don't think it looks that great anymore. Matter of fact, the study showed that it doesn't look that great anymore. And, small companies haven't done as well recently. So that's why that would be the case. So this stuff is, and if you're confused, okay, I get it. This is confusing. I'm sorry. But this is the reason that I think you've got to be super careful about where you get information. You hear people coming out there out of the woodwork saying, this is better, this is better. And I'm saying, no, there's a lot of research. There's a lot of information to show that this is not a better thing. It's not as liquid. It's problematic. You don't have the ability to turn it into cash. It's opaque. You don't know what you're investing in. You don't know what these earnings are going to be. But there are a lot of people that they've got a big dog in this fight because they can charge much, much higher fees for these private equity investments. Now, will you be able to avoid it in your 401k? You probably will. You probably will. Thankfully, you'll probably be able to avoid it. But you've got to watch out because this is probably coming to a 401k in your area, and your 401k may be adding it. You've got to make sure that you are looking under the hood as to what they're actually investing in. I'm not a big fan of this. And it's simply because there are just too many unknowns, and there's too much, and private equity in general is a big unknown because they want to stay that way. They don't want to have their information out there. And thereby, when you're investing in these things, you're paying prices and you don't know if you're paying a fair price because you don't know what you're buying. When I buy a public company, I know what those earnings are. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.